Welcome to this week's version of the Options Hour on TFNN. I will be your host, Victor Jones, and for the entire hour we'll be talking options. That's everything from equities options, futures options, options, and we're going to be talking about the market. We've also got some underlying stocks, as always. We like to take a look at. We've got Apple. We're going to talk VIX, we're going to talk gold, we're going to talk crude, we're going to talk bonds, we're going to talk everything today. We've got a full hour of the show, so it's going to be fun, and the market has given us a lot to talk about over the last couple of days. And so we want to kick that off. If you're watching in the Tiger Den, I apologize, guys. We've got some firewall issues. I'm broadcasting to you from the East Coast today, so it's a little bit different than the doomy gloomy Chicago. I'm just kidding. It's actually quite nice out there. It's somewhere around 70 degrees, and the same on the East Coast. We're happy to be here. Got some firewall issues, but we're going to have, like I said, we've got a powerhouse of a show today. We should have a nice, fun 1 hour in the show. As always, before we get started, let's do a quick market wrap. The market right now, when I refer to the market, of course, I'm referring to the S&P 500. We're currently sitting at 1377, up $10 on the day. So wouldn't you know it, it's kind of this interesting thing. We talked last Tuesday. We say, hey, we're sitting at this 1375 level. We are thinking it's an interesting time to buy a little bit of protection, sell some. It was really, we talked about selling upside calls. And if that's a new term to you, we'll talk about what that actually means. But why did we talk about that? Well, we talked about selling upside calls, but more importantly, buying some put protection. Well, why did we say put protection? Well, at that time, the VIX was somewhere around the 18 level, and if we had, or 17, 18 level, and if we saw a little bit of a pullback, which we did, we could see interesting VIX levels rising, or volatility would be rising. So you had relatively cheap volatility there. So, but we didn't rule out, selling calls. We talked about selling calls. We talked about selling call spreads, and interestingly enough, from a VIX that was somewhere around the 17, 18 range, we saw a quick correction to about the 1330 level, and now a rally up to 1378. We saw a high again today. We're now seeing a VIX at sub 15 levels. So, it's interesting. Over the last year or so, we've been having these conversations. We've been watching the VIX, and as many times as you listen to the show, I talk about the relationship and in the ranges with which the VIX is making over time. And you noticed, in the middle part of last year, we were trading right around the 35 to 45 handle. We level shifted, as you can see from the drawings on the charts, to about a 35 to 30 level. Then it was basically a wide range from 20 to 30. And once we broke sub 20, it was kind of a, hey, where are we now? Let's really take inventory here and see where we're at, and we're trending ever lower. Really, the bottom part of that next range that we set between 20 was 20 and 16, and we broke below kind of that 16, 17 range in the VIX, and we're now at, again, unparalleled territories for the last couple of years. And it's no surprise that at the same time you're making new lows in the VIX in terms of where we've been over the last couple of years. You're seeing new highs made in the market. I mean, we're seeing levels here in terms of the S&P 500 that we haven't previously seen until, for about 4 years, maybe since 2008. So, with that, I know I digressed a little bit from a market wrap. 1377, the SPOs are up $10. The Dow Jones futures contract, of course, we are now sitting at 13,000 and some change, 13,002, up $104 on the day. Interestingly enough, the Dow is moving in about, from a percentage change standpoint, pretty much in tandem with the S&P 500. Then you've got the Nasdaq. The Nasdaq today, 2670 and a quarter, up $23. The VIX, as I mentioned before, 1491, down 73 cents on the day. A big net change on the day when we talk about the VIX, but we're going to come back to that. I think it's important. If that's a new term to you, trust me, we'll explain exactly what's happening in the VIX there. The dollar, in terms of the DX/DX in the ThinkorSwim software, $80 even on the day, up about 8 cents. Again, the DX contract or the U.S. dollar index. It's something that weights the dollar against a basket of foreign securities. So you have Forex where you can actually compare the dollar, let's say the euro dollar. I think a lot of the times we might be watching financial news networks, you're seeing the euro dollar quoted, and that's great, but you're really just comparing the dollar versus the euro, which I think in terms of what's moving the markets, in terms of the European debt crisis, it's important to know what that relationship is. But also there's some some geopolitical things that are happening specific to the euro that aren't necessarily happening with some other currencies. So I think it's important to recognize that relationship here, and that's why we like to quote the dollar index again. $80. It's just broke about half a penny. 79.98 and a half, up 7 and a fifth of a cent. Gold here now $16.99, down 70 cents on the day. We are definitely going to talk about that because, as we mentioned, we caught it at 1550, right around the 1600 level, and we started saying once we approached that 1800 level, hey, from either a technical perspective or from whatever we wanted to call it, at there it started to get a little heavy, and we've seen a little bit of a pullback there, and we want to talk about it. I think it's interesting. I definitely think, there's so many people that are basically saying, hey, if you would have invested in gold over the last X many years, you could have made this. But I think if you're listening to this show, you have an interest in the markets, right? You've got an interest in your portfolio, and I think there's not many of us who are putting the entire portfolio anyway in something and just socking it away. We're interested in the moves, the relationships of the markets, and finding ways to play those different areas for shorter or longer term gains. So, in doing so, I think it's important to understand relative strength and weakness in these different markets. And we've talked about that there with gold. Crude oil now trading 107.09, up 75 cents, right around the level where we talked about it last week. Basically 2 weeks ago, actually. I was out last week, so Don took over. Hope you guys had fun last week. As always, the veteran took over for last week, so I'm sure that was a fun time. 107, right around where we were at 108 2 weeks ago. We've talked about this over and over. There's a little bit of risk premium built into the crude market right now. From a dollar perspective and where the dollar is, from where crude oil and where some of the metals are, it's kind of an interesting relationship. What you're seeing there in terms of crude oil pricing versus really where the dollar has been, where the equities market has been. You're seeing a little bit of strength come back into the equities market, but you're seeing a little bit of weakness in the metals market, but you're still seeing relative strength in the crude market. At the same time, you're seeing strength on the dollar. So it's an interesting relationship there that we have working really. Now, as always, and that concludes the market wrap. By the way, that's the market wrap section brought to you by ThinkorSwim. No, we're gonna have some fun today. I think there's some names that have always been in the market that I continue to mention, that we continue to talk about week after week, and that one, starting with Apple. And today, again, we've made a new 52-week high at 562.40. We're now trading 562.30, up $10.26 on the day, up about 2%. So essentially, you have seen, and this wasn't anything new. I mean, we caught that news article maybe 3, 4. It was actually probably a month ago. When the rumors were that on March 7th they'd be announcing a new product. March 7th actually is when they sent out, or actually March 3rd or something right around there is when they sent out the email announcing a new product. March 7th they officially announced, and we're now seeing the fresh shipment of iPad 3s start to hit the stores over the next couple of days. So, you're seeing Apple here, 562.40, essentially responding to that action, responding to customer demand up until this point of those announcements. But I think what we want to do here is essentially look at some of the option plays here. If you're bullish, if you're bearish, it doesn't really matter. There's interesting action, I think, taking place here in the options market. We've only got 3 days here in the March expiration, so at the same time you're seeing these new highs made at 562.25, up $10.29, $10.30. You have an interesting kind of roll that's happening. You have new highs that are being made. So you have people that are coming in potentially participating in the market for new times on the buy side or the sell side, but majority on the buy side, and that's why the market's moving up. Obviously, that's just, that's basic market fundamentals. But more importantly, you have this roll that's happening, people moving out of the March positions and potentially putting on their April position. So regardless if you have a March position on today and you're now looking at, I think regardless of what you might have done with Apple, whether it was, selling a call spread and now the market has probably significantly moved through your strikes. If that were the case, depending on where at what point in time or with what timed expiration you put those on, or you sell put spread, I mean, you're probably, with given Apple's recent movement and previous movement, there's not many cases there if you sold puts or put spreads where you're not going to be zero bid on your short strike. And so looking exactly how we can close out those positions, roll them into April, and what positions and level sets to expect for the next month. As always, if you're sitting right now with let's say, a short put in Apple, and this could be, and I'll open, just to show you, or just to give an example of what exactly I mean. Apple right now is trading at 562. Okay, so 562, that essentially means anything with a 500 strike, in March, of course, or below, has a bid price of 5 cents or less. At ThinkorSwim, you can buy in any short options at 5 cents or less, and essentially at no cost, at no commission. And that's important because if you sold puts here, right, if you sold puts, you sold put spread, you essentially, at a 500 or less of a strike, you've essentially, made, let's say you sold that for, if you, let's assume that the lowest increment in strikes here is 5 strikes, okay? 30%, 25% is going to be right around, or 20% is going to be right around $1. So let's assume you sold it right around $1 to $1.50. Okay, and your short strike is now 5 cents or less. That essentially means you've made anywhere from $1.40 to $1.45 in that market, and you're now holding on for 5 cents of profit, even though the probability of that occurring is very, very low of us going down and hitting or touching your strike. You can just clean up the risk, clean up house, so to speak. You can buy in those options. You're only let's call it sacrificing $5. But what is that $5? Well, if the intent is to have a position on for the next, let's say, 3 trading days plus, as you know, if we're selling premium, if the intent is to have some position on into this weekend so you can take advantage of theta or time decay, putting on the April position, cleaning up house and putting on an April position would allow you to essentially make that nickel in some other option, in an April option, given theta and time decay over that same 5 days. But it's also going to, it's also going to allow you to take advantage of what happens, or let's say it's also going to allow you to alleviate your gamma risk. So you have whatever credit you've made up until this point, you have now a short option that's trading at 5 cents or less, and you have extreme gamma risk. If the market moves, the acceleration of the value of your option into expiration is going to be exponential, and you're doing that. You're taking on that gamma risk for essentially $5. Does it make sense to take on that risk for $5 just because you don't want to pay the cost of transaction? Well, at ThinkorSwim, you don't have to pay the cost of transaction, so you can clean up that risk. And this goes. I'm using it as a put on the put side in this particular instance, but that's only because Apple has had a significant run to the upside. It could happen with any other market. If some other market you're trading has moved in the opposite direction, you're sold calls or call spreads, and now you have a short option with a bid of a nickel or less, that applies there as well. Cleaning up the gamma risk or cleaning up your short option risk, I think, is imperative, especially when we're approaching expiration, with 3 days expiration, because as you know, expirations, especially a triple witching expiration, and that's what we're approaching right now. We're approaching one of the biggest expirations. You have the futures coming off, and you have quarterlies coming off, and you also have the equities market expiration coming off. So it's a very busy expiration, and in busy expirations, the historical performance is that you see a little bit more volatility. You see a little bit more movement. You see interesting and quirky things happen into expiration. So, cleaning up that risk, especially going into this next couple of days, I think is important. But other than looking at that 500 level, let's look ahead a bit. Let's look at what volatility is telling you in terms of and I'll just give you an example here. Given where we and when I say we, I say the market, where we are pricing the March options for Apple. Essentially, we're giving it a standard deviation, or basically a 68% chance of moving $12 to the up or downside. Now, if you were to look and you say, hey, we just had a move of $11 to the upside today, and you're thinking to yourself, between now and Friday, where can we go? And the expectation is somewhere inside of $12. You could. There's two thoughts there. Well, hey, we just moved $11. How much more can we move into the end of the week? Or, hey, we moved $11, so it's definitely possible that we move $12 to one side or the other, which is what brings what brings up my point here is when we go into expiration, these options get cheaper. It'll be the 500 strike is going to be 5 bid today. Tomorrow maybe the 520 are 5 bid. The next day the 540s are 5 bid. But as those things happen, take advantage, close out your risk, and move to the next month. And we've talked about what the expected move in Apple is between now and 3 days from now. But more importantly, 38 days from now or into April expiration, what can be expected? Now, clearly, as an options trader, volatility is not going to tell you the direction of the move, right? But it is going to tell us a magnitude of move. And right now, while the VIX is at somewhere around 15%, let's call it, while the VIX is around 15%, you're seeing basically double that in terms of volatility in Apple, at least price movement priced into Apple here at 30%. So in April, it's no different. You're seeing 29.5% volatility in April, which is an implied move or an expected move, we'll call it, of about $43 in either direction. So you have an implied move for April of $43 in any direction. Now let's just take us, let's take a step back and you say, hey, we've made a move from essentially 420. Because if you took a step back basically 1 month and you said, where was that range? Apple found 400 and gravitated around it kind of like a magnet. A couple of times we hit 420, but that was it. And as we made a move into earnings, essentially Apple stuck at 420 right before earnings. Essentially, right when we got earnings, we gapped up, and ever since then, there's been announcement after announcement that's took us ever more higher. I like to use the term ever more because I used it once in a chat, and it was kind of an interesting play of words. So let's keep going with it. But now we're at 560, and you think to yourself, well, where's that upside resistance? Well, just round numbers in the market in general tend to be an area of resistance, just psychological resistance, if not heavy technical resistance. So you're looking at 563, and you say, okay, to the upside, what kind of, just in general, what's the next big round number? And it's 600. Now we look at volatility, and we look at what volatility is telling us, and it's telling us an implied move about $44, which puts us, guess where? Right at $600 on the upside, at 520 on the downside. So I think as you go into April expiration, that's really, if we're looking at what implied volatility is essentially telling us today, and I think there's a little bit of premium built in because of the unknown or what's going to happen with sales, with the iPad 3, essentially what we're going to see there. So I think you might see a little bit of increased implied volatility in these options right now, but from 560 to potentially up to 600 is potentially your upside resistance from a quantifiable analysis of the options and option pricing today. And downside is 520. Now that will definitely change. Volatility is going to change, and new information is going to come to the market, and we're going to see kind of a change or repricing there. But as we go into April and we're thinking to ourselves, I'm rolling this position, I'm putting new positions on, where's my range here? What's the end game here? And I think right now the options are pricing 520 to 600 as being those boundary levels, so to speak, given current pricing. So with that, knowing that the upside here is potentially somewhere around 600, and it starts to look a little bit heavy from current implied volatility, what does that price out to right now? What does the risk price out to here? And it should, in most cases, in all cases, the risk there should be proportional to the probability of success in that particular instance. So we've just mentioned that the implied move is somewhere between is basically on the upside $600. So if we look at that and we say, well, from a standard deviation perspective, we would expect 62% of the time we would be trading inside of a range of 520 to 600 between now and expiration. Well, if we know that, then we would expect we would have at least, we would have a 62% chance or greater of selling, let's say, a 600 call. Well, why is that? Well, a call essentially means you have the right to buy the underlying security at that strike price. So if I buy a 600 call in April today, and it's trading, just so everyone knows, at $7.85, if I buy a 600 call in April, I essentially have a probability of about 24% that option is in the money, essentially that we're trading at $600.01 or greater, and the probability of that right now is about 24%. So I would expect, if I took the opposite side of that, if I'm not the buyer in that 24% market, if I'm the seller of that market, I'm now taking on a 76% chance of a probability of success. In other words, if I'm selling the ability or the capability of Apple to reach 600 between now and expiration, that given current market pricing and the way you can analyze those options, 76% chance of probability of success. In other words, that we expire below 600. So knowing that, you should be able to find a spread that pays out equivalent to that risk. So if you look at the 600-605 call spread right now, it's priced out at about $1. It's really $1.05, but it's a 5-wide spread. Okay, it's 5 strikes wide, but you're taking in $1, so your real risk is $4 in this particular trade. The width of the strikes is 5. So the way that you can always find, and I know we talk about this from time to time, but it's it's so imperative that I think when we're going into these to trades, especially option spreads, that we understand, hey, there's a probability, there's implied probability assigned to the trade that you can derive from the price of the spread that you're paying or selling it for. So I look at this again. $4 is my real risk in the trade, $5 wide. So if I take $4 divided by $5, I get 80%. Basically, it's 80% probability of success in the trade. We just said the real probability is somewhere around 76. So you're seeing that's why I get paid about $1.05, and it works out to the exact same math. So you're seeing that you could look at an option spread now. You could look at, and again, I said the 600, 605, just so everyone out there, if this is, your first time hearing or understanding or following along with what a spread is, in this particular instance, this short call spread would be selling the April 600 call spread and buying the April 605 call spread. I'm doing this for example purposes, just to explain probabilities, to explain how this concept of implied volatility works in the marketplace. But again, if we were to do that, it prices out to about $1 right now. So $1 means my real risk, or the width of the strikes between 600 and 605 is $5, and I get $1 to place the spread. So 5 minus 4 is $1. So basically, my risk here is $4. And the strikes are 5 wide, so 4 divided by 5 is 80%. And so we know going into this potential trade that we're going to get $1, we're going to risk 4, and the probability of success here is about 80%. And interestingly enough, if we do the same exercise on the opposite side, let's just take a look at what we're getting here. So we mentioned the downside is somewhere around 520, upside 600, downside 520. Let's price this out a little bit. And if we look at the 520s, we're getting a little bit under $1, interestingly enough. I would imagine because we're at 563, it's actually more realistically, it's the 525, 520. There we go. So the 525, 520 gives us almost the exact same price. We get $1.02 for that, which is right around where the mid price was on the 600. And we don't have to do the math again because we know we're 5 strikes wide. Again, for those of you listening, we're now looking at the price of the selling the 525, the April 525 put, and buying the April 520 put. That's a vertical put spread. And so in that particular instance, you get $1.02, same price. And to do that, again, the probabilities are 80%. So it doesn't matter here if you're listening and you're bullish or you're bearish on Apple. I think that the important point that we're making is how to do this, regardless of what your play is, to take your play and do something that gives you a high probability of success. So if the market here is 564, we'll call it 563.5. Let's analyze what happens in both of these different scenarios and strategies. If we were to sell the 525, 520 put spread for $1, our break even here is a price of 524 in Apple. Okay? Let's just say it's 524 in Apple. Well, the current market is let's call it 564. So we've got $40 of downside protection. That's 8%. That's about 8% from where Apple is trading today. It's 563. It's somewhere around 8%. So you have 7% downside protection. In other words, if Apple stays where it is today and you sell the 525, 520 put spread, you'll make that $1. If Apple rallies, does an infinite percentage, you'll make the $1. And if Apple sells off from now until expiration anywhere less than 7 or 8% to your 524 strike, you'll make the $1. So when we look at really, well, really, if it sells off anywhere less, 525 would be your break even to actually make the $1, and then anywhere over 524 you're actually making money. So just to clarify that point. So that's on the bearish analyze. So you're essentially saying that you have room to be wrong, 7 to 8% on the downside, and you have all the room in an infinite manner to be right on the upside. Now let's analyze the opposite. If, again, we sold to use those 600, 605, and I'm just using this as an example. There's room to be creative in how much credit you take on and how much risk you take on. But if you were to sell the 600, what does that mean? Well, essentially, you've got 40 points of upside protection, which is 7 to 8% on the upside. You got 7 to 8% on the upside in terms of protection, and if the market rallies anywhere under that, you'll make your $1. If it stays where it is, you'll make your $1, and if it sells off, you'll make your $1. So there's ways in which to use these strategies that we're talking about in a way that is a little bit more flexible than just trading the underlying stock or just going outright and buying calls and buying puts and trying to pick direction. In this particular instance, we're giving ourselves this huge gray area to be wrong and still be successful in the trade. And so when we look at this market, and as you're listening to this show, it doesn't matter if you're bullish or bearish. I'm not saying this is a golden strategy if you want to do either. But the idea here is you're giving up unlimited profits because you're never going to make more than you actually sell the spread for. We'll never make more in this particular scenario more than our $1 that we went in and we initially sold it for. And in giving that unlimited upside potential up, we increase our probability of success. Everything's a trade-off in the marketplace. If you want unlimited upside potential, you're going to take drastically reduced probabilities. I can't give you something. I'm never going to give you something at current day's price that has infinite appreciation attached to it or capabilities. I'm going to I'm going to take a little bit of that premium away from myself, so that if in fact I'm going to take any future value and attach that to a current price in order to be profitable myself. That's any asset, regardless if we're talking options, equities, it's housing, it's anything you want to talk about. You have to consider future value in terms of current price. So with that, let's do a quick market rally. We want to jump into some other things that we've been looking at here over the last, how long has it been now? 6 to 8. Actually it's probably been about 3 to 4 months. So again, as a quick market wrap, the SPOOs have not moved at all. 377.25, up 10 and a quarter. The Dow Jones 13,005 bucks. So we're up about $3 since the last time we quoted at $108 up. Again, keep in mind that 13,000 number. We've talked about Apple. I think we want to jump into some of those indices and just talk about where we are, where we're sitting. 1375, basically 1380 here is an interesting upside resistance number, a heavy upside resistance number for the S&P 500, and 13,000, as you know, and has been quoted all over any financial news outlet or network you've been listening to. It's that 13,000 number that keeps coming into play, and we finally, with today's rally, we've put ourselves again above that number. The VIX here, 1505. A little bit of rally in the VIX since the last time we quoted here. We're now down 59 cents on the day. What's interesting here is you've seen an uptick in the VIX. You haven't yet seen a downtick in the SPOOs or in the Dow. So what will be interesting over the next 30 minutes, we'll keep an eye on that, and we'll see, hey, we've had an uptick in the VIX of a good percentage. We haven't seen the market fall back. Let's see in the next couple minutes if we get a couple downticks here and where the market is. The dollar index is up a penny since we last quoted, 80.01, up 9 and 7/10 of a cent. Gold 16.97.80, down $2 on the day, and crude 107.18, up 84 cents. Let's jump into the gold market. GC. This is something they kind of got beat over the head with into the end of last year, and I hate to, it's some of these things. As you listen to us and you listen to this show, this isn't a show where we're giving recommendations. We're just talking probabilities. That's all we're ever doing, and that's all you really can do when you're talking about options. I mean, you have to listen to other shows to really get recommendations, but here we're talking about probabilities. And as we approach the 1600 level, and you saw that essentially being a base, and as we picked up steam from the 1550 and kind of overshot the 1600 level, we made that point. We talked about, hey, we're at a 1550, 600 level. From a probability standpoint, this is how we see it. And interestingly enough, you saw a rally up until 1750, where we started saying, well, the market reached 1800 last time. And again, it's not always indicative of past performance isn't always indicative of future performance, but the market reached 1800 last time. And had a significant and a sharp sell-off given where we were in the equities market. As we reach 1800 today, or the last couple of weeks really when we last noted it, the market was at 1800, and now we've seen a quick sell-off to 1700. We've essentially given up 100 points over. We basically did it in a day. Now we've been hanging around there for the last week and a half, but it's basically we sold off almost 100 points in one day. And so it's just probabilities here that we're looking at. So now as we sit at 1700, and we look at, well, what's I don't want to say what's the play, but what are the probabilities telling us? So if we look at GC, I'm looking at the futures contract right now. When I quote this, when you hear me say, 1700 level or 1697 where we're trading at today, down 230, I'm quoting the actual gold futures contract. That's the contract, the active month. Even though the March contract, the futures contract is actually active, and quoting. The activity and the liquidity has moved to the April contract, so we're quoting the April contract right now. So what I'll do here is actually make this relevant for everyone. If you're not comfortable trading futures or futures options, I'm just going to use GLD here, which is an ETF that tracks the gold market in a similar 1 to 10 fashion. Not exactly. It's at 164.87. So if you look at where we were just quoting right around 1690, an exact 1 for 10 would be somewhere around 169. So GLD is tracking at 164. And so you look at that, and it's had very similar action. Its upside was 175. It gave up about $10 from 175 to 164. One moment here, guys. So from 175 to about 165. And now we're sitting at 165. So we're going to use those numbers here as we analyze the gold market. So I'm going to jump in, and we're just going to jump in and say, okay, what is volatility telling us here? Again, we did the same analysis when we were looking at Apple. We're going to do a similar comparison here. Basically, from now and 38 days ahead into April expiration, volatility here of the April series is about 19 1/3%, just a bit over, which means that market has an implied move from now until April expiration, about $8.32. And you can see that right on the ThinkorSwim software. So if you're wondering, hey, how does he get these numbers? We can have a whole show on how to apply those numbers. But if you're using the ThinkorSwim software, it tells you right on the options chain that exact number. So $8.32 is that implied move of GLD, the gold ETF, currently sitting at 165 or 164.92 until expiration. So if we're at $8.32. If we're at 160, let's call it 165. The upside potential is somewhere around 174, which we just mentioned was upside resistance the last time when we sold off about $10. And to the downside, that puts us right around 157, 156, 157. So let's do the same analysis here. And we jump into this market. We're looking again at the implied move. Well, what does that mean? If we're currently at 165, that upside strike would be somewhere around, the 173, 174 level. So I'm going to pick. We're going to get a little bit more aggressive and look at the 172 and see what that actually is pricing out at. It's going to be really close to our previous example. So right now, the 172, 173 call spread. Again, this is selling the April 172 call in GLD and buying the April 173 call. Currently, it's priced at about 19 cents. It could be, right around 20 cents is what we were expecting, but it's just a bit under, between 18 and 19 cents. So let's just round it off. Let's make it really easy math for everyone who's listening at 20 cents. Well, if this is one strike wide, remember we were doing 5 strikes wide before in Apple. This is one strike wide in GLD, so it's $1 wide. You're making 20 cents. Your real risk here is 80 cents. So if your real risk is 80 cents, we divide that by $1. That's really easy math. Your probabilities here, well, guess what? It's 80%. So in a very similar manner to how we just analyzed Apple, upside, downside, support, resistance, and what that means to options and option pricing. We're doing the same thing here with GLD, and we're seeing an 80% probability of success in potentially utilizing this particular strategy. But as I say it like that, we have to understand that, as we say, 80% chance of probability. That's today's number, given today's pricing and today's implied volatility. And tomorrow, the price of gold is going to change a little bit, and the implied volatility is going to change. And so that all those different factors are going to change your probability of success, and it's not a static number. But if you're just trading options today with no notion of quantifiable numbers and probability and risk to reward scenarios, it's imperative that we understand these types of numbers as we're going into these strategies. Because obviously understanding what we're doing and the probability of success going into something is definitely a little bit better than doing something kind of on blind faith or on feel, or what I mean, this idea that I kind of think this is where we're going. Well, that's easy. Anyone can come to the market and pick a number out of a hat. And if you want to do that, really you're playing a 50-50 game. But in this particular instance, we're using numbers that the market is giving us to derive probability of success. And here again, 80% probability of success in the upside. And what does it also equate to? It equates to the same number, same area in the 173, 174 area where you saw a significant, let's call it a correction, not once but twice now over the last year. So you can see on this upside, this potential move, it equates to something that's happened, basically 2 times. But again, this factors into, well, how comfortable are you with the market here at 1377? Because if we have a correction here, which I think is interesting, because the market was at 1377. I said 1077. The market was at 1377 with an 18% VIX. We shot down. We gave up $20, and we've now rallied back to 1377. Well, basically, maybe we shot down about 15 to 17 points. We're now at 1377 again with a 15% VIX. So it's interesting to note that relationship. We're 3% less, let's call it fearful or nervous, or basically the VIX is indicating that there's basically a 3% difference in the implied price distribution or nervousness about the market at the same price than we were basically basically 2 weeks ago. So it's interesting to note those little things, and we'll continue to watch the VIX and how it moves with the marketplace. But we've done our upside analysis here with GLD. Let's do the same thing on the downside. So our 165 market here in GLD, we looked at, basically $8 to the upside. We're looking at, where we're analyzing right now, selling the 172, buying the 173, which is about $7 up from the current market. If we take $7 down, we're looking at the 158, 157. And if we do that here, guess what? Same price for the spread, 19 cents. It's interesting how that works out, right, guys? But if we're selling the 158, again, just because there's people listening here that I don't think can see my screen, let's really talk through what we're doing. We're selling the 158, the April 158 put. This is what we're analyzing: selling the 158 put and buying the 157 put behind it. You put those together, and you now have a short put spread. You have a short vertical spread for April that pays out about 19 to 20 cents. We're going to use 20 cents for our analysis just to make it, again, easy math. You do, 20 cents is what you're receiving. $1 wide is how wide it is. 80 cents is your real risk divided by $1, and that's 80%. So 80% that we probability of success here, basically that we hit our break-even price or above. To mention our break-even here, because we're getting 20 cents, is not 158, it's 157.80 is really where our break-even in this particular strategy is. When I give the break-evens, I'm not giving transaction costs. Again, you do have to factor transaction costs into not only your probability of success, but into your break-even points. But here, when we look at just pure pricing in the marketplace, at 157.80 is our downside resistance. It's $7 lower than the market. Now, the market is currently at 164, right? So we're $7 lower. Essentially, we're about 5%, a little bit less, about 4.5% protection. Right? We have 4.5% protection on the downside, and to use the same numbers, that's the amount of protection we have on the upside. So again, it doesn't matter if you're bullish or bearish here in gold, because we're talking through strategies in both. But we're doing so with the same mind frame, and you can see so many times. I think some in a very wise person I've heard speak said, the difference between a good trader and a bad trader isn't the instrument you trade. A good trader and a bad trader can trade the same instrument, but a good trade is someone that uses probabilities in their favor. A bad trade is, something that really doesn't position you any better than 50-50. And a bad trader, in some cases, it's a position that gives you smaller probabilities of success based on no real market thought or logic on what's happening in that marketplace. But here again, with this particular instance, there's an 80% probability of success. You have a 4.5, anywhere from 4.5 to 5% protection to the downside. Same thing with the upside. So we're looking at that gold market, and we're saying, hey, here's our range. Let's just call it 158 on the downside, 173 on the upside. And then if you want to couple that with technical analysis, by all means, let's do that. What's happened at these relative areas in the past? 158. If you look at the gold market, you have a little bit. Shortly there into the end of basically into the end of January, you had we stalled out at that 158 number. I wouldn't really call it a resistance area. I think it was probably just a slowing of momentum. And you had basically at the end of December kind of a gap area where we gapped from about 163, we gapped down to 158. So you have this this gap fill type of resistance or support that might be built in there. But I think those are really, you're looking for things in the chart to be something at 158. I don't think that's anything specific in that market, at least over the last 3 months. And to the upside, you're saying, what does 173, 174 actually mean to this market? And those have significant, I think, upside resistance indications just from a technical perspective. So, as you look to pick those, I think it'll be interesting whether you're bullish or bearish, but you have kind of strategies there for both. We've gone through strategies, and they aren't the only ones. But vertical spreads are a great way of implying probability, and that's why we go over them, I think, very often in this show. Let's go ahead and we've got about 10 minutes left in the show. Let's do a quick market wrap here. The SPOO's now trading a buck higher. Interestingly enough, we've been a diversion here. 1378 up 11 and a quarter. The Dow Jones 13,006 up 110. So the Nasdaq here 2674 up $27, and the dollar index 79.96 up 5 cents on the day. Gold again. The futures contract 1697.50 down 250, hanging right under that 1700 number, which it in all honesty, it's been gravitating around in the last couple of days. As we go in, we've talked about Apple, we've talked about gold, and the last thing I want to talk about here today is, again, the crude market. I mean, we've been following it. We're going to mix it up a little bit next week, and we're going to talk about some new instruments, so that'll be interesting. But we have been tracking these for the last couple of months, and it's been, up until this point, crude has kind of been something that's offered interesting analysis. And I think here is still the case, but it's almost the same case that we were talking about 2 weeks ago, which is there's risk premium built in at 108. Interestingly enough, it's interesting to be above that 100 level, given where the Dow is, given where the equities market is, given where the metals are. But again, you saw that move from essentially 98 to 108 happen in quick succession. I mean, literally session after session after session after session, that risk premium being built into that market. We're now set at 107.25, up about 91 cents on the day, just shy of 0.75%. And so we're sitting here at 107.22, and the market is really gravitating around this 108 number, 107 number. If you want to talk about ranges at all, you've got about 110 to 104, which is played in basically inside of this 2-week range. But I don't, that's not enough time. It's not really an established time for a range. When we were looking at this market before, there was basically an established range between a 98 and 103 level. It just kept playing that really nice kind of range for us. And ever since we broke out at that 102 level, it's kind of established itself here at this 107 level. It'll be interesting to see what we do here. But I just want to offer that same type of breakdown, because I want to, in this show, and hopefully you've seen it, it's all about how to use implied volatility to derive support and resistance numbers. And then really, from implied volatility, from a percentage standpoint, what probabilities you're going to get from those support and resistance numbers. So that's, hopefully you've seen from this show, that's what we've been talking about. Let's go ahead and just drill it home here with USO. And if we look at USO and what series are essentially available to us, we've got the same thing. We've got March and we've got April. April with 38 days to expiration. Again, if you're already in USO, you're playing it, you might be, if you haven't closed down your March position, you're potentially looking to roll it either today or tomorrow, before liquidity dries up into Thursday and Friday. You might see those spreads widen a little bit. If you've been doing this long enough, you see that into Thursday and Friday, as some of those larger institutions, as some of the bigger players move their positions from the front month into that next month. Well, if you don't have as many trades there happening in any market, if you have less participants, you have less liquidity, you have looser or wider spreads. So if you're looking to roll positions, or looking to close positions, basically after Wednesday of expiration, as you get into Thursday and you get into Friday, and later into Friday, you're literally going to see a bit of an expansion, or the correlation will be to historically see a bit of an expansion into those spreads. So if you start, just be aware that if you're going to hold that later into expiration, that it's going to be harder and harder to work for the theoretical value, or basically the mark price of your spreads. And as you get further and further into expiration, be aware that in working towards expiration, and if your position is such that you need to close it, you might be in a position where you're going to have to work and give up a little bit of edge in order to close those positions. So as you look at how to manage expirations, and we're closing down here March. We got 3 days left as you're working towards, hey, how do I close down really what's happening here in March and roll into April? We got 3 days. You just be aware that as you head into Thursday and Friday, it's going to be harder and harder to work for theoretical value. Again, in April, you look at the volatility here in April in USO, and what it's telling us, hey, same thing. We got 30%, very similar to Apple, almost twice the underlying market volatility here, which essentially gives you an implied move of USO of about $3.17. Well, $3.17 in a market that's $41 is about 8%. Just close to it. I'm ballparking the numbers here, so forgive the math if it's a little bit off, but it's about 8%. So you have an 8% implied move from now until expiration at about $3.17 up and down. We'll just call it $3 just to round it off just a bit. So we're at 41 today. $3 to the upside is going to bring us to 44. $3 to the downside is going to bring us to 38. And if you look at, again, what those strikes are doing, we're going to take a quick look at the upside 44 call. We're going to look at this one, and it's actually somewhere around 12 cents. Now, what does this mean? Well, with 12 cents here in April, if we want to look at this probability here, it's the same thing. I mean, we're going to take the opposite here. It's about, we've got an 88% chance of probability of success. But we're only getting 12 cents, and we're going to take on 88 cents of risk. So here you have to say, hey, does it make sense to try and take on 80? Do I want to risk 88 cents to make 12 cents? That's always your call. As is, you just got to make the right call. And whether or not that's actually worth doing is it's a little bit different. So it's different to each person. So in this particular instance, to actually get that 20 cents or that 80% probability of success, you'd have to come in a little bit, and it would have to be the 43-44 call spread. Again, 43 selling the 43 call on the upside, buying the 44 call side. Buying the 44 call behind it gives you about 20 cents. Again, 19 cents. And from there, you do that same math, and you get exactly what we've been doing this whole time. So with that, you've got about $2 of difference. $2 in a market that's $41 wide is about 5%. So you got 5% protection on the upside. If in case you were bearish or a little bit bearish biased here in the market, and you wanted to take a strategy that allowed you to be wrong, and if you're right, you'll receive the credit. You're risking one. You're basically risking one. You're risking 4 to make 1. Those are the types of things that we just looked at all day long, and there's room to get more aggressive. But hopefully you've seen, how we can take these different markets, a bullish or bearish scenario, put them together, and create something that actually gives us a high probability of success. And that's what today's show was. Hopefully you guys, we didn't take any questions for this show, but we had a lot of stuff to get through. And I told you guys we had a powerhouse, so we really want to appreciate everyone for listening for the last hour. Quick market wrap as we wrap up the show. The S&P 500 here, 1378.25, up 11.5. Actually just ticked up to 11.75, so we're having a little bit of a rally there. The Dow is at 1310, now up 113 points, so up a little bit more here as the VIX is upticking, now up to 1505, down 59 cents. Thank you, everyone, for the last hour. It's been a very interesting options hour on TFNN. I've been your host, Victor Jones, and we will see you next Tuesday. Same place, same time. Thanks, everyone.